If you've been looking at boats lately, you've probably noticed something strange. Prices that were firm 6 months ago are suddenly negotiable. Dealers who wouldn't budge are now calling you back. And if you walk through any major marina right now, you'll see rows of shrink-wrapped boats that look like they've never touched water, all sitting there with price tags that keep dropping. This isn't a seasonal thing, it's not a regional quirk. What's happening right now is the biggest inventory correction the boating industry has seen in decades, and it's creating opportunities most people don't even know exist yet. Let's start with what you're actually seeing on the lots. In early 2025, brand new 2024 model boats started appearing online with 40% markdowns. A cruiser that stickered at $200,000 suddenly listed for $120,000. Dealers called them spring incentives, but if you read the fine print at the bottom of those ads, the real term kept showing up: liquidation event. At a Fort Lauderdale auction in March, I watched a row of identical center consoles sit under those harsh overhead lights, each one tagged thousands below what the dealer paid for it. You could actually track the panic through their own bulletins. Every week, another revision cutting prices lower than the last. These weren't clearance sales. They were survival moves by showrooms that are paying daily interest on boats nobody's buying. When demand slows but the loan clock keeps ticking, price becomes the only tool left. Every markdown you see isn't generosity, it's a distress signal. And if you know how to read those signals, the next few months are going to separate the smart buyers from the ones who wait too long. Here's what the numbers actually show. According to the National Marine Manufacturers Association, retail sales fell about 10% from May 2024 to May 2025. Factory shipments dropped 12%. But here's the part that matters. Inventory climbed 25%. That means more boats are piling up on dealer lots than leaving them. Every additional boat sitting on that lot adds another line of interest to the dealer's floor plan loan. Imagine paying a mortgage that grows every single day while your income shrinks. That's the math dealers are dealing with right now. And when they can't move new inventory, they stop taking trade-ins, which freezes the entire used market too. Buyers are feeling it as vanishing resale value. A 1-year-old pontoon that sold for $80,000 last summer is now wholesaling for barely $50,000. That's not a rumor. It's what's happening at auctions across Florida, the Carolinas, and the Great Lakes region. This glut didn't happen overnight. It's the delayed hangover from 3 years of overconfidence and cheap credit running straight into a consumer base that simply tapped out. The math doesn't lie. The real question now is who's still building boats while all this inventory sits unsold. Let's roll the clock back to see where this oversupply actually started. Go back to 2020. Lockdowns froze travel, and suddenly freedom on the water became the marketing slogan of the summer. Stimulus checks, low interest rates, and easy loans turned marinas into showrooms. Manufacturers ran double shifts because every boat they built was already sold. By 2021, demand looked endless, and lenders started extending 10-year loan terms at rates under 3%. For 2 seasons straight, it worked, until inflation hit and those rates doubled. The same buyers who financed at 2.9% are now looking at resets above 7%. That's hundreds more per month on boats that are already worth less than what they owe. The production lines built for that boom kept running even as orders quietly dried up. Dealers took delivery on inventory financed with yesterday's optimism, but paid for at today's rates. That's why repossessions are climbing and why manufacturers are quietly talking about furloughs. You can't turn off debt like a faucet, and interest doesn't care that the market changed. The pandemic may have ended, but the payment plans it created didn't. Factories can downshift production. Debt doesn't have that option. Drive past any regional storage yard this summer and you'll see the evidence lined up like tombstones. Hundreds of late-model boats shrink-wrapped and waiting for buyers who never showed up. Drone footage from Gulf Coast facilities shows aisles packed so tight that forklifts scrape gel coat just trying to park the next arrival. Each one of those boats represents thousands in monthly interest, insurance, and storage fees that are bleeding dealers dry. Some have started running silent auctions, hoping cash buyers will take units off their hands before lenders step in and call the collateral. Local newspapers in Indiana, Florida, and the Carolinas have been reporting canceled boat shows blamed on scheduling conflicts. But people inside the industry know the truth. Dealers can't justify the cost of travel when their own lots already look like trade shows. Every unsold boat sitting under plastic eats into the margin on the next 10 they're trying to sell. And more shipments are still coming in from overseas plants that were built on demand forecasts from 2 years ago. So where do all these boats actually end up when dealers can't move them? The answer isn't pleasant, and it's not the showroom. Repossessions start before sunrise. The low rumble of tow trucks backing into suburban driveways while the neighborhood's still asleep. Across the country, repo contracts tied to marine lenders have surged about 30% since last spring. You can see proof of it in lender bulletins that get quietly circulated to dealers, warnings that asset recovery operations are going to intensify through the third quarter. The reason isn't complicated. Adjustable rate loans written in 2021 at 2.9% are now resetting above 7%. For thousands of owners, that change adds $300, $400, sometimes $500 a month to payments on a boat that's already worth less than the loan balance. When you owe more than the boat's worth, you're trapped. Some people just walk away. Dealers receiving these repos aren't celebrating new inventory, they're suffocating under it. Each repossessed unit floods the auction supply and drives down prices on everything else still sitting unsold. What used to be a trade-in opportunity has become a value trap for owners watching their resale collapse in real time. Every tow strap tightening around a bow rail drags the entire market a little lower. But not every used boat showing up for sale should even be there. Some of them were never truly seaworthy to begin with. Behind every flood headline, there's a shadow economy. After last year's hurricane season, insurance companies wrote off thousands of boats as total losses. Within months, many of them reappeared online under clean titles, sanded, repainted, and listed as lightly used. It's called title washing, and it's thriving right now. Investigators with the National Insurance Crime Bureau have flagged dozens of VIN mismatches in coastal auctions, where boats declared salvaged in Florida suddenly re-emerge, registered in inland states with no damage history showing. Moisture trapped in foam cores, salt corroding wiring harnesses buried in the bilge, structural stress hidden under a coat of fresh polish. These aren't cosmetic issues, they're ticking repair bills. Buyers chasing a bargain rarely check the National Motor Vehicle Title Information System, and most dealers don't volunteer the full history unless you ask directly. One former insurance adjuster I spoke with described it bluntly. If it still floats, someone will flip it. The result is a two-tier market. Legitimate trade-ins losing value right next to resurrected wrecks that are built to fail again within a year or two. A buyer who doesn't verify the history ends up paying twice, once at purchase and again when the real problems surface. Because some of these so-called bargains have been underwater twice. And even if you manage to avoid those traps, there's still another gatekeeper shaping what you actually see online. Online marketplaces promise transparency, but in practice, they've become toll roads. Lawsuits filed earlier this year accuse major listing platforms of ranking search results based on seller fees rather than fairness. Screenshots leaked from dealer dashboards show identical boats, same year, same engine hours, appearing pages apart because one seller paid for visibility credits. For buyers, that means the honest price might never reach the first page. Algorithms learn your search behavior and adjust pricing suggestions upward, rewarding higher margins for dealers willing to spend more on placement. Even private sellers have to pay premium subscription tiers just to stay visible beyond a few days. It's quiet manipulation wrapped in convenience. One buyer in Texas shared screenshots of two 22-foot center consoles, both listed at $85,000. Within 48 hours, the lower-priced ad vanished entirely, while the higher one got bumped to front-page rotation. That's not coincidence. It's monetized perception. This isn't conspiracy theory. It's digital leverage designed to keep desperation hidden behind paywalls. Even finding a fair price now depends on who controls the search bar. And when visibility costs money, the factories start feeling the silence too. On paper, the slowdown looks like strategy. Production cuts of 20 to 30% reported by major builders like Brunswick and Beneteau sound controlled. In reality, it's triage. Regional suppliers in Indiana, Florida, and North Carolina are confirming canceled purchase orders and shortened shifts. Where assembly lines used to hum all day, forklifts now sit idle. Local news outlets in small port towns are telling the human side of this. Fiberglass techs clocked out for the last time. Upholstery shops shuttered. Diners near the factory gates closing early because there's no lunch rush anymore. The ripple runs deep because every finished boat carries a supply chain behind it. Engines, wiring, trailer frames, each one tied to its own small business. When the orders stop, cash flow dies within days. Executives call it production alignment. Workers call it what it is, layoffs. It's the manufacturing version of a repossession, assets reclaimed, labor written off. And if production stays muted through this winter, that ripple's going to roll back to dealerships struggling to get warranty parts by next spring. The silence on the factory floor is about to echo in your local marina, because when production stops, support stops too. Markets don't move in waves, they move in tides, and the smartest buyers know how to wait for the pullback. Over the past 24 months, used boat auction data shows two predictable troughs every year. The first one arrives in late winter, between January and March, when dealers face their highest floor plan interest charges and rush to unload inventory before the spring buying season. The second window opens in early fall, right after the new model year launches, and last year's unsold stock turns radioactive overnight. Prices fall fastest when storage costs climb and buyers vanish. You can see it clearly in regional auction reports. Average winning bids drop 15 to 20 compared to mid-season sales. Waiting through all the noise and summer temptation rewards the disciplined buyer. The trick is to track the timing, not the headlines. A dealer's fiscal pain becomes your discount. The longer they hold unsold inventory, the more leverage shifts to the buyer with patience and cash ready. Patience isn't free in this market, it's profit. And once that window opens, you need to know exactly what the real number looks like underneath the sticker price. Every boat listing has two prices. There's the fantasy on the windshield, and then there's the truth at the auction block. To see through it, you start with wholesale data. Services like J.D. Power and Black Book both record actual sale prices from dealer networks and closed auctions. Let me walk you through one example. A 2024 Bowrider shows an MSRP of $129,995. That same model, lightly used with under 50 hours, just cleared at a Tampa auction for $101,000. Add about 5% for transport and dealer prep, and you land around $108,000 retail. That's your ceiling, not your starting bid. The goal here is to reverse engineer emotion into arithmetic. If a salesman starts spinning a story about strong demand, you counter with numbers and silence. A spreadsheet beats a smile every single time. Knowing what the dealer actually paid through floor plan financing gives you an edge they can't argue around. Once you can quantify the markup, you strip away the mystery and most of their leverage. Once you see through the sticker, emotion can't rob you. And now it's time to use that clarity at the negotiating table. Negotiation isn't a showdown, it's a sequence. Step 1 is always inspection. Prove the boat's condition before you ever discuss price. Step 2 is presenting the math. Reference real data and let the numbers do the talking first. Step 3 is the offer, a firm figure backed by proof, not a vague range. Step 4 is silence. Dealers rely on small talk to rebuild control during pauses, but silence is pressure they can't train against. Typical dealer margin on new inventory runs between 12 and 15% before you account for interest costs. Every extra week a boat sits on the lot eats about 1 percentage point of that margin. If you show up informed and willing to wait, the clock works for you. Rising interest rates are already squeezing their cash flow, which means a quick cash buyer cuts their risk instantly. That's why flashing funds too early actually weakens your hand. Reveal cash only when the deal is ready to close. Liquidity talks, but timing shouts louder. Cash isn't loud, it's leverage, but only if you time it right. And knowing when to act is only half the battle. Knowing what to buy determines whether that leverage actually lasts. Not every segment is sinking at the same speed. The survivors in this market aren't the glamorous ones. They're simple, efficient, and cheap to run. Small outboards and aluminum fishing boats are holding value because they cost almost nothing to store and maintain. Fuel's not a concern. insurance is reasonable, and almost anyone can tow them. Mid-size cruisers hover somewhere in the middle. They're comfortable and still manageable for most owners. They'll drop in price this year, but they'll recover fastest once buyer confidence comes back. Then you've got the big twin diesel yachts, the so-called prestige class. They've lost up to a third of their resale value in a single season. Fuel costs, insurance premiums, and marina fees turn them into financial anchors. Buyers chasing luxury right now are going to watch their assets depreciate faster than they can enjoy them. The real winners in this correction are the people treating boating like a tool, not a trophy. Durability and simplicity keep you liquid when the market shifts, and that's the only status that actually matters once the dust settles. Durability beats prestige every time. And that mindset's going to matter even more as the broader financial system starts tightening around credit and supply. The next phase of this collapse isn't going to come from the docks, it's going to come from the banks. Since 2022, the average boat loan APR has climbed from around 4% to nearly 9%. That spike has effectively doubled monthly payments for anyone trying to finance a new boat right now. Lenders who were once eager to approve borderline applications are now declining them outright, citing elevated risk exposure in marine lending. Refinancing, once a way out for struggling owners, has dried up almost entirely. When rates climb that far, loan-to-value ratios flip, and borrowers can owe more than the boat is worth by the second year of ownership. The result is a credit choke that starves both buyers and sellers. A dealer can't move inventory if nobody qualifies for financing. Private sellers find their trade-in offers shrinking every single month. This isn't theory. It's a cycle you can see on every rate chart published since the pandemic ended. When the lenders freeze, the buyers disappear. And when sales vanish, the impact doesn't stop at the showroom door. It spreads to every business tied to the water. Walk any marina this summer and you'll see the ripple effect firsthand. Service technicians who used to repair a dozen engines a week are now standing idle. Local newspapers in Florida, Michigan, and North Carolina are reporting layoffs by the hundreds as repair yards close and storage facilities consolidate. Marinas that were built during the boom are now defaulting on their own loans, leaving half-finished slips sitting empty and baking in the sun. Even cleanup costs are rising. Abandoned hulls left to sink or rot are straining local budgets. Counties along the Gulf Coast are now spending tens of thousands removing derelict boats before they break apart and leak fuel into protected waters. Each closure cuts deeper into waterfront economies that depend on steady seasonal work. Cafes, marine supply stores, charter guides, they all feel the downturn just as sharply as the boat builders themselves. The boating slowdown isn't just a market correction, it's a community bleed. When the docks go quiet, the breakfast tables in every dock town go quiet too. And whether that silence becomes permanent depends entirely on what happens next. The industry's standing at a fork in the road right now. One path is a reset, production cuts, softening interest rates, and balanced inventory levels. The other path is a reckoning. Oversupply, tight credit, and weaker brands collapsing entirely. The warning lights are already flashing. You want to watch the national clearance rate, the factory backlog ratio, and repossession trends. A clearance rate above 70% with shrinking backlog signals recovery on the horizon. Rising repos combined with flat backlogs mean continued decline. Each bulletin the NMMA publishes is already showing the direction this is heading. The choice ahead for builders is discipline or denial. Companies that flood the market again risk extinction. The next year isn't about selling more boats, it's about surviving the debt they already built. One number is going to flash first, and it won't be on a press release. That signal is what decides who buys smart and who gets buried under misplaced optimism. For the cautious buyer, opportunity doesn't come from rumors or dealer ads. It comes from tracking actual data. Your dashboard is simple. Follow the NMMA monthly update for any divergence between production numbers and sales figures. Check regional auction volumes. If listings start shrinking week after week, prices have likely bottomed. Watch the dealer floor plan index that gets released by marine finance firms. When their delinquency rate stabilizes, it means credit is starting to thaw. Combine those three signals and you'll see the market's pulse before anyone else does. When all three align, falling inventory levels, stable credit conditions, and steady auction clearances, that's your window. But here's the critical part. Wait about 3 more weeks after that alignment happens. Then, negotiate while the panic's still lingering, but before demand actually returns. No influencer, no advertisement, no salesman can replace those numbers. They tell the truth quietly and consistently. Let everyone else chase the headlines. You'll be reading the gauges instead. So here's the bottom line. This isn't a clearance sale. It's a correction, and it's rewriting the entire boating market in real time. The next few months are going to separate the buyers who panic from the ones who profit. If you want to stay ahead of the repos, the rate hikes, and the misleading deals, hit subscribe right now. Because when the next wave hits, and it's coming, I'll show you exactly where the real opportunities are hiding before they disappear. What are you seeing in your local market? Are dealers in your area cutting prices, or are they still holding firm? Drop a comment below. Every story helps us track where this correction is breaking fastest.